Hey everybody, welcome back to the Remote Real Estate Investor. My name is Emil Shore, and today I've got my co-host with me,
Tom Schneider.
And Mike Laubbaum.
And we're going to be talking about and breaking apart a video that we've seen floating around on YouTube titled Why Real Estate is a Lousy Investment. And this was from a speech from Warren Buffett and Charlie Munger during one of their annual conferences. So we're going to break it down, tell you what the video says, and give you our thoughts as to why we believe this title is absolutely wrong and why real estate is actually a great investment. So let's hop into this one. All right, guys. So we all just watched this video and the title is very clickbaity, right? Why real estate is a lousy investment. And I'm sure that was created for a very specific reason to get a lot of YouTube clicks. But when we all watched the video, there were some very clear takeaways. First one, which is in like the first minute or two, Warren Buffett actually talks about how Charlie Munger, his business partner, actually made most of his early money in real estate, and that why they believe real estate is a lousy investment is actually why it's a lousy investment for Berkshire. And so he lists a couple different reasons. You guys want to talk about those reasons real quick?
I'll start with it's a double clickbait article. It's not just why real estate is a lousy investment. It's Warren Buffett, why real estate is a lousy investment. And I think I'll let Michael speak a little bit more to one of the arguments, which is the tax implications. Michael, I'll let you lead that part of it. But
of course you're giving me the tax.
you know, there you go.
Smooth, Tom. Smooth
transition. But I'll speak to one of their arguments. Is one of them is they didn't feel that they had a competitive advantage and they were mainly speaking to commercial buildings, like talking about like Chicago Class A office. Their argument is that is priced pretty effectively. So they didn't feel they had much of an advantage in any type of price discovery. And I think, there's such an industry in institutional capital in that like larger, Class A commercial space. It makes sense that, as them and as an investor, they're looking for value in other spaces. It's not necessarily that it's a lousy investment. It's just like that's not where their kind of bread and butter is, even though it was in the very beginning of their career. So, Michael, I'll let you transition you over to the more technical response on the tax aspect.
Yeah, appreciate it.
Yeah,
I think just kind of to paraphrase what you're saying, Tom, for our listeners, is they just can't seem to find deals, or they don't think that there are deals out there to be had where there's a disconnect between what the investor can buy it for versus what it's worth. And so in that market that they talk about, that Class A commercial stuff, they're just not seeing deals to be swept up. So I think that's kind of the point they're making. So regarding the tax structure, I'm going to do my best here. Full disclosure, not a tax professional, not a tax expert, but there are different types of entity structures in which you can have as a business. You can have a sole proprietor, you can have an LLC, you can have a C Corp, you can have an S Corp. Just real quick side note, have you guys ever seen Arrested Development?
Yes.
Oh yeah.
So good.
Where they talk about instead of a limited liability company, they want to start a no liability company.
Rest Development, so good.
Money is in the banana stand.
It's so money good. Is in the banana stand.
That's always money in the banana stand. So you have your LLCs, you have your S Corps and your C Corp. So they are taxed differently and they are treated differently as entity structures. It's not all the same. And so determining what is the best entity structure for you as an investor is a really personal decision, and it's a bit of an in-depth decision. There's not a one-size-fits-all approach. And we talk about this a lot, that you don't necessarily need an LLC to start investing. And there are tons of investors out there that say LLCs are kind of ridiculous and maybe a little bit overdone, and so you can do it in another way. So Berkshire was talking about, they were talking about Berkshire Hathaway, about how it's currently set up as a C Corp. And so there really is not much of a tax advantage to be investing in real estate because of the current structure that they have. So that's why they said, okay, for us, it's a lousy investment. And that's like, Tom, to your point, they aren't looking at the types of deals that the three of us are looking at, and that a lot of Roofstock investors are looking at in the single family space or the small multifamily space, or even the commercial family value add space, they're just not playing in that same water. And then also I would argue that most of us as individual investors or partnerships aren't using C Corps. We're probably using S Corps or LLCs. And so that also changes the narrative around what makes an ideal investment. So just like we talk about in the academy, the way in which you purchase real estate, how you structure your debt, the type of mortgages you're using, how much down payment you're using, can drastically affect the outcome and performance of the property. Same thing can be said for the ownership side of things. If you are buying this in a C Corp, yeah, maybe it's not going to perform as well. And maybe Tom, you buy that Class A office building in a C Corp, and Emil, you buy it in an LLC. And Emil's like, yeah, this is a killer investment. It makes total sense because of all the tax benefits that you're getting as a result of that. Tom, you might think the opposite. So we really have to look at the whole picture, and you really have to understand who's saying it, how are they saying it, and what are they actually talking about in order to then make a determination for yourself. Hey, this is advice I should listen to, or maybe this isn't applicable to me. And so for that video, my takeaway was that really none of what they were talking about is applicable to me as an individual investor that invests in smaller and commercial, small multifamily deals with a value add component inside of an LLC. It couldn't be like more opposite end of the spectrum than from what they were talking about. And so for me, it's like, no, that's real estate's a great investment. It couldn't be further from a lousy investment.
Yeah. And I guess to belabor the point a little bit, I love analogies. So, Berkshire Hathaway is this huge conglomerate that's structured most efficiently for the type of business that it does. So that's like saying someone who's like training to be an Olympic weightlifter, what do they think about sprinting, or like, not that one is better than the other, but the way that you structure your business, both from a tax and a liability perspective, there's optimal ways in the many different ways that you can do it. And Berkshire Hathaway isn't structured for that type of business, right? And they speak to it that like the way that they're structured, there's not other companies that do it, and that based on their business, it doesn't make sense the way that they're structured.
Yeah.
Yeah. And that's like in thinking about turning like Berkshire Hathaway is this massive, massive company. We can think of it almost like a cruise ship. And to reorient a cruise ship takes a long time and is really difficult, and it uses a lot of fuel, and you need a very specific person to do it. And so to pick up these ones and twosies and threesies that a lot of the kind of mom and pop or individual investors are targeting, it would just be no way to do it effectively or efficiently. And so they're going to continue down the path that they're on, doing what they do because they do it really, really well. So it wouldn't make sense for them to try to go buy a single family home in Birmingham, Alabama for a couple $100 a month cash flow for a stellar return, because they're talking about billions upon billions upon billions of dollars in doing what they're doing. So they're smart in that they're staying in their lane. They know what they're good at and they know what they're not good at.
Yep. Exactly. And Warren says that at the end, right? He's like, it's just, we're not going to be able to generate a significant return for the level of capital that we have, right? And so the big takeaway for me is everyone looks up to Warren Buffett. Like, obviously you want to invest like in one of the best investors of all time, but you also got to know he's playing a completely different game from you. Like you're playing all of us, we're playing a completely different game than Warren Buffett. And so when you see headlines like this, it's good to remember that he's saying it for the level he's at. He doesn't mean that for every single investor everywhere. We obviously know, we talk about it. We have people who come on the podcast who investing in real estate has absolutely like changed their lives, helped them achieve financial freedom. Like if you ask them, it's the best investment they could have ever made, right? So just important to put context to all these things you see out there.
And another really quick side tangent, another one of those, have you guys seen Kevin Hart's stand-up where he talks about staying in your financial lane?
No.
Oh man, you got to go check it out. He goes, man, it's so difficult to go out with like all these big professional athletes because they all have so much money to spend. So when the bill comes, when they're out, it's $5,000 and they're all like, oh yeah, we'll split it. And Kevin's like, oh, I got to move money from my checking account to my savings account. So I can't give you my debit card. It's hysterical. He's like, just stay in your financial lane, know where you're at, play there. You're going to have way more fun. If you haven't seen it, I highly recommend you checking it out.
Definitely.
Cool. Do we have anything else to add here, guys?
I'd say just a clickbaity article.
Yeah.
A clickbaity article.
And, they talk about one last thing. They talk about not being operators or having any experience there. It's also, they don't want, like, I guarantee if Warren and Charlie wanted to become good operators, they would absolutely do it and crush it in real estate. They're just so far along and know what they're good at that they've stayed there. So, if you're early, like, there's only one way to become a good operator, right? You have to invest. It takes time. You get better at these things. And yeah.
I mean, that's a really great point, Emil. And to piggyback off that, I think that to generate the types of returns that they are consistently generating, they would need to go cut their teeth, so to speak, on a massive, massive real estate portfolio or a massive real estate project versus everybody who's just starting out or who's got a couple deals under their belt. I mean, you get to determine what kind of business you want to run and build that from the ground up. And so if you can go get your experience and cut your teeth on the single family home space or the small multifamily space or even the small commercial multifamily space, wherever it makes sense for you to begin, you can do that. And you can go learn those lessons the hard way and go to the school of hard knocks and really come away with, being a better operator, a more efficient operator, and then go look to scale up. Once you already have this huge business, to try to go learn something on the smaller scale doesn't make sense. And so you've got to go play in the upper echelon and go learn on the big scale. Well, that's really scary. And so we talk a lot about on the podcast, and I've said from my past career that we always used to ask ourselves, what's the bet? Whenever making a decision, what's the bet? And if you're betting a really big amount on your decision, then you better pay a lot of attention to it and give a lot of time and energy and focus to it. If the bet is smaller, then okay, roll the dice, see what happens. And so for Berkshire, their bets are big. And so they want to go learn it right. And it just doesn't sound like there's an effective way or an efficient way for them to do that.
Exactly. I mean, the amount of capital that's being deployed is just so key in here. And I'm looking at the market cap of Berkshire Hathaway, their Class A, it's, over $500 billion, like $660 billion. So like, if they wanted to like deploy money related to real estate that's of any significance, it would just be, you're buying these huge, Class A, whatever, multifamily or huge, commercial, and that's not their sweet spot. So, I mean, it's not even relevant talking about single family or smaller stuff for them to invest in that space.
And Tom, just for everybody who's listening who might not be familiar, what does a market cap mean?
It is the total value based on the shares outstanding. Well, basically what it is, it multiplies the number of shares outstanding by the price per share. So it kind of gives you a rough valuation.
And so bigger valuations means bigger dollars are at play, right?
That's right.
Awesome. Cool, guys. So I think the big takeaway here is that we're all smarter than Warren Buffett and Charlie Munger, and those guys should retire now. Just kidding. We're just debunking the clickbait out there. That's what we're trying to do. All right. Well, guys, this is a fun.
Just a couple of guys,
Yeah, exactly. Just a couple guys. All right, guys. Glad we had this conversation. If you're listening, go ahead on YouTube, leave us a comment. We're going to be doing a little bit of a swag giveaway. So leave us a comment, subscribe, let us know what you think of this episode. And make sure you check out our podcast playlist that has a bunch of previous episodes. And we will catch you on the next episode. Happy investing.
Happy investing.
Happy investing.